Hello, everybody. Welcome to Wednesday. This particular video is actually pre-recorded. I will be back tomorrow. Today's my birthday, so with any luck, I'm coming back from the beach, which I haven't done for quite a while. So I'm really looking forward to doing that. But I did want to cover something today that comes up quite often, actually, within the strategy sessions that I have with clients. And that is especially, how do we generate income in retirement? Lots of other questions come up about retirement. Do we have enough money? And that's where the financial plan comes in the Monte Carlo simulation. But in terms of just how do we generate income? How do we start to, get income? I'm been getting a paycheck and now I'm going to be retired, and how do I live? And so this is something that I have been doing for the last 35 years. I merged with Cam Neri back in 2005. She had been in the business for 40 years doing exactly the same thing on her own. So I think this is a strategy that is worth looking at. There's a lot of different ways of generating income, and some of them I don't think work as well as others. So let me describe what we're doing, and then I'll kind of show you some of the pitfalls of some of the other ones. So I'll start by sharing my screen here real quickly. And what I'm going to do is just show you, kind of a portfolio here. So this is our traditional model. This is the all stock portion. And again, we don't have tons of people in the all stock one. We have different mixtures, but this is a good example. And so what you can see here is I have 15 stock market portions in this particular model. And in our client base that is withdrawing money to live off of, we have 5% in the money market. We call this the withdrawal model. And so what we do is we say, okay, every single month, we're going to have a certain amount of money come out of this portfolio. And eventually what will happen is that this 5% will dissipate and it will come back down. And then all of these pieces will continue to be managed as normal. Some of them will be replaced, some of them won't, but some will do better and some will do worse. And so what happens is once this gets down to about 1%, then we rebalance the portfolio and put it back to 5%. And when we're rebalancing, we're kind of selling some of the pieces that are high and really kind of, putting those into that money market. And so it's a really great way of generating income. And so if we look at, more typical portfolio, I know this gets a little bit busy, but here's our 60% portfolio. Got the same 15 pieces on the stock, got our 5 bond market portions here. Here's our 5% in the money market. And so the key here is that you're allowed to kind of get a nice balanced portfolio that can grow over a period of time. It has interest, it has dividends, and all of those things are coming into this money market. And if that's not enough, we're actually then just kind of doing a rebalance to continuously replace those. And I think this is the most robust way of generating income. There's a lot of different ways. One way is people will buy very high dividend related portfolios. Well, when you get into high dividend stocks, those can be great, but number one, they can cut the dividend like AT&T just did. But secondly, really, they're a little bit sensitive to interest rates. In normal times when a dividend stock is sitting there and interest rates go up, the actual value can go down. And sometimes these companies are paying big dividends because they're not doing that well in the other part of their business. I'd rather have growth that I can get out of this whole portfolio. And I see other people that do big pieces of bond in order to kind of generate income. Well, of course, the bond market went down, in terms of the yield substantially at one point in time. And now that the yield's coming back, the price is falling apart. Matter of fact, I can show you a chart here. So this is the last 1 year of BND. So BND is the Vanguard Total Bond Market Index. I look at this as the overall US bond market. And of course, back in August is when we saw that, kind of peak out. And look at this fall that it's had. So if you had like an overabundance in the bond market trying to generate income, really you're just kind of out of balance in that regards. And that can lead to some disappointing results. So I much prefer, having a portfolio and basically just withdrawing from the money market and then replenishing that money market. And I think this is the best way. And we could be quite conservative. We could have more bonds. We could have, more stock, whatever that situation is. But that, I think, is the best way to really kind of see, what we might be able to do in terms of generating income out of a portfolio. So again, this is time tested. We've been doing this for a really long time. How much you take out is kind of dependent upon what you need, and then what your plan says you can actually afford. Those two things are checked out, and then once that's figured out, then we kind of go forward and really set that up. And people seem to like monthly pay instead of quarterly or annually, because that's how we all got paid when we were working, what have you. So, that's nice. You can get it at different points of the month, the 15th of the first or what have you. So really, really good situation as far as that goes. And that's what we set up for distribution of income. So again, I've presented this before. I still get some questions about it, and that's why I brought it up again. But I think it's an important component of what you're going to deal with. And you can really kind of mess up your retirement if you're not a little bit careful about how you withdraw that income, because you still want to get sort of a balanced portfolio, which I think is the most important part. The income is secondary to the overall balanced portfolio that you might be able to achieve there. So anyway, look forward to talking to you tomorrow, and I'll be back. Thank you.